Hello friends, welcome to my video series on using AI for investing. On the screen, whatever you see as tick mark or the use cases which have been completed so far. Presently, we are in the process of learning the different financial forensic models to understand the quality of the numbers in the financial statements and also learn how to prompt to gather inferences. Please, without fail, check this overview video to better understanding about financial forensics. The last three videos we have covered three models: Montier C-Score, Lev Tyagarajan model, and Benish M-Score. In this video, we will discuss about Montier C-Score. So that is among the tools. That tool is used for uh, identifying fraud and manipulation. So for fraud and manipulation, there are four tools. Venetian score we saw in the previous video. Then comes Montier C-Score, which you'll be seeing in this video. And before we move into the prompting, let me just introduce, give an overview of this model. This was founded by James Montier, who was inspired by the Venetian score, which we saw in the previous video. So this model would have come somewhere in existence after 2000, year 2000. So the purpose is to access accounting quality and flag potential earnings manipulation. So note the word potential because it cannot. These are all mathematical or statistical models which cannot accurately say yes a fraud is done or it's a clean chit, but potentially or probably. So it is based on some rules-based scoring system which we'll shortly see. There are six criteria. You see, each model uses different criteria and weightages are given to evaluate. In this model, there are six criteria, and the word C in the model indicates cheating. And if there is a cheating, there is 1 point given to the criteria. Higher the point, more the risk or more the manipulation. Ideally, if you are looking for clean company, the points for all the six criteria, what you see on your right, should be 0. There should be no cheating, and 6 indicates the highest risk. So, what are the different? This thing is six criteria. Is it compares cash flow with income, the debt in the balance sheet, asset quality, then rising depreciation, and change in total accruals. The last one is higher auditor's risk. Means there's a change in auditor for some reasons. So now we go to the prompting. So this is the prompt which we'll be using. On the screen you can see Montier C-Score. I want to calculate so-and-so score for the attached financial statements. Use the six criteria and give 1 point each. Present as a table with the criteria, present value and calculation. Always I insist on calculation so that I can see whether the model has picked up the right numbers from the financial statements. And lastly, the score either 0 or 1. And I have told that for every assign 1 point for each red flag detected. So I'm telling not to calculate auditor's risk criteria. The reason being, I'm only going to attach the balance sheet, profit and loss statement, and cash flow statement. There is no mention about whether the auditors changed or not. It is for you to find out from the annual report. Pull out the last year's and the present year annual report. You see who is the auditor last year and who is the auditor this year. If it is the same person, there is no change. If there is a different person, there is a change in auditor. So that part we are not going to give it to the model. So I'm telling that to not calculate auditor's risk criteria and conclude the summary. So now we move to run this model. The first one is the usual case of the carborundum universal. So it's already uploaded and we'll just run the prompt. Okay, the first point is declining gross margin. The score is 0, means it's not declining. Declining asset turnover, yes, it's very negligible, like 0.08 has become, 0.09 has become 0.08, but still it has awarded a score of 1. For all other six criteria, like increasing day sales, increasing leverage, and so on, so the score is 1 out of 6. Only one red flag is identified. Rest all are positive indicators. Overall assessment, it summarizes with the so red flags if any. It summarizes whatever it found. See, only one of them has a score of 1, and even that is very minor, 0.01. A single minor flag, red flag, minor asset turnover decline is offset by multiple finance positive indicators. So now we'll repeat the same with Gensol engineering, and we'll put the prompt here. Attached Gensol engineering. Let me mention here Gensol engineering financial statements. Now let us see how this result turns up. I purposely took two contradicting scenarios. One is the carborundum, which is a well-established company. Another is a Gensol engineering, which has been in the recent news for corporate governance. So let us see the results. A declining gross margin, score 1, cheat. Then 2, score 1. So I told you, whenever there's a score 1, it indicates one cheating or one of that criteria is a red flag. So out of 6, 5 are what do you say, red flags. So it discusses all the 5 red flags. Then there is positive indicator, yeah, good growth, all that. Then high risk factors. Then overall assessment with a score of 5, it shows Gensol is in high financial distress risk. Have you run this model or have you done this same Montier C analysis maybe 4 or 5 months back? And if this result came, I'm sure as a long-term investor, you definitely would not have even looked at this company again. So I think we will complete this video, and soon we'll catch up with the next model. Bye till then.